Sup Money Masters, I hope you are all having an awesome day. Today is Risk Part D. Do not fret yourselves, dear subscribers and non-subscribers who are potential subscribers. Today is not additional things you have to worry about or learn about. Today is merely the executive summary of risks part A, B and C. Let me summarize it all for you. Let's rock and roll. I see on the screen that only the top of my shirt is sticking out and it may be a little bit distracting, but check out the school t-shirt I got. Surfing the motherland. You can see the little surfer there at the bottom. I love this t-shirt. Okay, summary. In part A, I discussed how the industry measures risk and a typical, let's say, picture format or graphical format of how they would show you what risk looks like in different products that you can invest in. And in those type of products, I broadly refer to unit trusts and mutual funds, but there are other things like ETFs that I will get to in another video. But just to recap and remind you what that would look like, they would show you a risk expected return graph, and the idea is the more risk you take, the more return you can expect. And we went from cash or a money market fund at the bottom, low risk, expected low return, up to the equity block and expected high return. And I said to you that even this equity block, which is at the top right on this picture, shouldn't scare you, because this is only the secondary thing that you should be worried about. And I also explained, and I'll show you on the graph again, that there are riskier things out there. And I explained that starting your own business could be a lot riskier than investing in a product that falls in this risk category. Also, I said that this is higher risk, so the potential return could also be very good. And the way that the industry measures risk, the mathematical formula or the statistic they use to determine the progression of these blocks is called volatility of return. So the reason the cash block is down here and the equity block up there is because of the difference in the volatility of return. And what does that mean? It just means that when you're invested in that left lower corner cash or money market block, your expected returns are each month and each year very similar. They don't differ a lot, so there is a lot more certainty about what you can expect in terms of returns. While if we go to the top right hand block, the equity block on that graph, the returns of that type of investment is a lot more volatile. So the volatility of return is higher. There's more uncertainty about what you can expect from that product's return. And higher uncertainty means higher risk. So that is the way that the industry measures the risk. But what I said, that's secondary. And what I wanted you to focus on were a couple of points that I think is your main focus for determining your risk. What does the industry try and do? They don't know you. They can't tell you what risk you should take. What they try to do with this representation of the products using volatility of return is to try and steer you to say which products have lower risk and higher risk. But they can't know. The industry doesn't know what your risk is, your risk profile is. And what I said is your primary concern about risk is to create first your own risk framework. And what did I do there? I said you must focus on the following, and that is your risk. Your biggest risk is losing money. Now, just a pause here. I also explained in part C that just because the market is down and your portfolio value is down, remember I spoke about anchoring, I spoke about recency and negativity bias. Just because it's down, you haven't lost money yet. It's when you sell at that point that you realize that loss. But if you follow these other steps on the slide, let's have a look. Doing nothing is probably the biggest risk you can take. Okay? Go and check out Inflation Part B if you want to understand that. You must do something. There is no such thing as no risk. There is only lower risk and higher risk. Then, to determine your risk framework, after you've decided I can't do nothing, you've got to answer these questions. What are you saving for? This is where you start. What am I saving for? You will hear a lot and read a lot about having a long-term plan. That's great. You should have a long-term plan for your retirement money or some other money. But you can't have a long-term plan if you need the money in 2 years, 3 years or 4 years. And if you do that, you've answered the question, what am I saving for? I'm saving for perhaps something other than my retirement, which could be 10, 20, 30 or 40 years away. That's a long-term plan, and that's great to have one. But if it's something different, then you've got to associate the risk you want to take with that, what are you saving for? And once you've answered the question, what are you saving for? That will determine your time horizon. Okay, and the longer time horizon you have until you need the money, if you are disciplined and you can keep your hands off it, which you should, the longer your time horizon, the more risk you can assume, and then the volatility of returns, even that equity block that looks very risky on that graph, becomes less and less and less risky the longer period you have until you need the money back. Then also I said expectations. This is part of your risk framework. Once you know you have to do something, you know what you're saving for, and that then gives you the time horizon you have until you'll need that money back. You have to have the right expectations for the product you're going to invest in, and I'm going to get back to that because that's part of the summary of risk part B. And then always expect surprises. Morgan Housel, whose book I've mentioned many times, has got a quote in there, or a chapter actually, a whole chapter on you must expect expectations. You must expect your plan not going according to plan. So let's continue on to the summary of risk part B. And in that video, I talked about why we don't like taking risk. What is it in us that causes us to now know how to create our risk framework, but we're still scared, we're still risk averse. And in that section, I talked about risk aversion, our tendency to be risk averse, not wanting to take risks. And I spoke about type 1 and type 2 errors, false positive, false negative, and that humans, we all suffer mostly from the type 2 error, which means we see risk everywhere, we're scared of risk, we want to protect ourselves, and therefore we sometimes see risk and get worried, like about that equity block that I said is not that risky, but we see it there, and because it's at the top, we already get nervous about it. And one of the reasons I said that happens is because of the experience, the emotional experience we have when we make money or lose money. So I showed this graph. The experience, the joy you experience from making $50 is about 1 unit, let's say. But if you lose 50, the pain of regret of losing the same amount, 50-50, is double what you experience in terms of joy. So our emotion of the pain, the regret when we lose money is double when we make money, the same amount of money. So that plays into our risk aversion. We want to avoid that pain. Also in part B, I mentioned what you could expect so that you can start getting your mindset right, your expectations right for when you invest, about what type of money you can expect in return for taking the risk. And there I mentioned Nicky Numbers. And this tweet that he sent out a couple of days ago where he took a diversified portfolio, I explained that in part B. It's not quite that equity block. It is something that's got 80 in equity and 20 in bonds, or call it also income generating assets. And what he said is you can expect 1.5 times your money back after 10 years. And just to note here, that 1.5 times your money back is not when you take, let's say, $10,000 and you invested 10 years ago and you leave it. What he's talking about here is dollar cost averaging, which is the discipline that you should practice of consistently putting money into the market, let's call it on a monthly basis. Each time, if you do earn a salary or you do earn an income that's monthly, every time you pay yourself first. How do you start saving? That video of mine. And you keep putting money in the market every month, year in, year out, according to your risk framework and your time horizon. This is after 10 years, you can expect 1.5 times your money back. In other words, if we take the example where you would have taken $10,000 and put it in and left it and not done dollar cost averaging, after 10 years, what he's saying, you're going to get 1.5 times your money back. So you put in 10,000, and when you sell all your investments, you should get back 25,000. That's how it works. And then after 2 years, you can after 20 years, sorry, you can expect 2 times your money back. After 30 years, 2.5, and after 40 years, 4 times. That is just to help you with expectations. And I mentioned in this case the book that Nick wrote recently that was released, Just Keep Buying, which is about the dollar cost averaging. And I'm sure there's other interesting stuff in there. I haven't read it yet. At this stage, I'd have to import it to my country. Here in Africa, it's not that readily available if I wanted the physical book. And then the other thing I didn't mention in part B, but I think is important to note, is that over the long term, we're talking here 100-year history. In my country, the real return of equity is about 7%. And in the US and developed markets, broadly speaking, it's about 6%, 6 to 6.5%. Now remember, real return, I did a video on what type of returns you get. Real return was one I discussed. It really means over the last 100 years in my country, you could have expected a return from that equity block of approximately inflation plus 7. That's a real return. And in developed markets, it means you could have expected inflation plus around 6.5%. Okay, so that should also just help you to understand what type of rewards are available if you determine your risk framework, you have your time horizon and all of that sorted out, and you take the appropriate amount of risk. So in part B, to conclude, is really we are risk averse. We don't like taking risks because we try to protect ourselves from the pain. And I also said, when you've decided to take the risk, you must have the expectations. You can also expect to go through the pain. And basically that at the end, just the numbers of what you can expect, the rewards you can expect if you do invest. And then in part C, I spoke about the risk of our emotions, emotional bias that we all experience. We all have emotions, we all have these emotional biases, and I mentioned in that video, part C, that there are many emotional biases, but I focused on 5 of them that I thought, or still think, has got the biggest impact on us when we invest. And those emotional biases are negativity bias, which I've already now discussed about risk aversion. We are negative, we want to prevent the pain. So negativity bias, we are prone to be more negative than positive. Recency bias, we place a lot of value on what happened to us recently, and we expect that to continue happening. Example, the markets this year, 2022, is down. Now we can expect, because this has happened to us this year and we are in it, that this may continue going on. There was a very good tweet yesterday by, I think it was Charlie, I'll check, but if you check my Twitter feed at MoneyMasterSJ, I retweeted the tweet, and it basically said if you take the historical numbers, the probability that 2022 was a down market and that 2023 will again be a negative market. So in other words, from January to December, it will be a negative number, losing money. if you sell, is 9% only. So it's not 0, but it's 9% that we'll have a negative market again. So what could happen if we're too focused and stuck with this recency that has happened to us now, we think that's going to continue, we could be missing out on excess returns going forward. The other biases were confirmation bias, which really means that if you already think a certain way or believe in something and you hear the same thing being echoed by, let's say, an expert, or you see something like people on the news saying, yeah, the markets are a bad place to invest and all your money is going to be lost, and you're already negative, risk averse, that confirms that, and that could be very dangerous. We have to look at the facts and make sure that we don't just confirm things we already think and believe when the facts are saying something different. Overconfidence bias and the difference between luck and skill. Overconfidence was where when things go well, instead of poorly, when things go well, we get overconfident in our own ability. And it's not always easy to say, should we be confident because we have skill, or is it because we're just lucky? And what I said, and this is very important, the worst thing that can happen when things are going well, specifically in investment markets, is when you get so overconfident, you may only have been lucky, and then you go and borrow money because you think this is an easy game, can easily make money, it's been going so well, I'm confident. You borrow money to invest in the market, and then when things go poorly, you are shooting your own left knee off. And then finally, I spoke about anchoring bias. Anchoring bias is really where we anchor to our first impression, or sometimes with recency bias, our most recent expectations or what we've seen, we anchor to that. As an example would be if you've been investing, you've been putting money in the market, you've received a return, you look at your investment and let's say the worth is $500 worth. Now the markets go down, you've anchored to the 500, you look at it again, suddenly it's 450. And you get a surprise. Now you've anchored to something, your last impression, or sometimes your first impression is markets are very dangerous. That equity block I explained is very dangerous. Oh, it's a risky thing. And then you're anchored to that, you don't invest in it because you've now anchored and confirmation bias that is risky, and then you could be losing out on returns. Especially if you've already determined your own risk framework, and that tells you that you should be taking and can be taking on more risk and perhaps should be investing in that equity block as an example. So there it is. That's really the summary of part A, B and C. I hope you enjoyed it. It was fun bringing it to you, and I hope you learned something. Assuming you did enjoy it and you did learn something, please remember you can like the video and you can also subscribe whenever you see this icon. This is the subscribe icon, and you can follow me on Twitter at MoneyMasterSJ on Twitter. What's next? I'm going to take a little bit of a break because it is summer holiday period in my country. So depending on where you are, I'm in the southern hemisphere. It is summer in December, and I'm going to take a bit of a break. And then in the new year, what I'm going to do is I've decided to do something on stock markets. And to do that, I thought I'd start at the beginning, really. What is a stock? What is a stock market? What is a stock market index? And from there we'll lead into things like what are ETFs, exchange traded funds. So I'm looking forward to bring that to you. I'll see you there. If you're having a break, have a good one. Cheers.